Welcome, everyone. Wishing you all a happy 2022, and may this year be a good year for all of us. Thank you for joining the ORT Jet webinar series this morning. For those of you who are new to ORT Jet, we are an organization that empowers entrepreneurs in our community through mentorship, networking, and training. If you'd like to know more, please contact me after the event. Our guest speakers are two dynamic entrepreneurs, Scherzer and Josh Kotlowitz. They have created Future Forex, a business specializing in digital asset arbitrage. This conversation is an opportunity to educate ourselves further so we have a better understanding of the crypto space. Please feel free to post comments and questions in the chat box, and we will address them at the end. A reminder to keep your microphones on mute. Harry and Josh, thank you for your time and sharing this conversation with us. Over to you.
Awesome. Thanks so much, Lisa, for the really warm welcome. And yeah, thank you everyone for joining today. We're really excited to be here. I'm going to hand over now to Harry to introduce what we're going to be talking about. Oh, and I must share my screen. Let's get that up. All right, can you guys all see that? Cool, getting thumbs up. Harry, take it away.
Yeah, thanks very much for inviting us, Lisa. We're really excited to be here, and yeah, it's an honor, a privilege to chat to everyone here about what we've done, but more so about the crypto space at large, which I know is filled with a lot of skepticism, so I'll definitely address that. Let me start off by introducing us a little bit more closely. So a couple of years ago, Josh and I started Future Forex, which performs something called crypto arbitrage. It sounds more complicated than it is, but we'll go more into detail into what that is. But in a nutshell, we grew extremely quickly. We now have a team of over 20 people. We've processed over 1.4 billion Rand for our clients, making returns, making really strong returns. And one of Josh and my common passions, is the need to educate people. So we felt that particularly in the crypto space, where education is very much at a premium, there's not much education going on. People don't really understand it very well. It's not currently regulated in South Africa, and because of this, people tend to veer away. And what we want to talk about today is how to actually make money with crypto, and doing so in a way where you're careful enough that because of the lack of regulations, you don't get scammed, you don't have any issues in that regard. So I'm hoping that by the end of this presentation, you'll walk away with more knowledge as to how you can get involved in crypto without getting into too much trouble. Just before I move on to our agenda, I do want to mention that in terms of the lack of regulation, there is regulation coming proposed for the first half of 2022. And our compliance team has been looking at this and monitoring this very closely to ensure we're in line with this regulation when it does come to fruition. So let me move on to our what we'll be discussing, our agenda for today. So I've done an introduction into who we are, what we've done, and thereafter I'll take you through crypto arbitrage, which is where we have our deepest knowledge. It's what we've specialized in for the past 2 years. Thereafter, I'll hand over to Josh to chat through direct investments in crypto, as well as something called crypto mining. I'll then take you through the space of DeFi, which is decentralized finance, and hand back over to Josh to talk through NFTs, following which we'll conclude and have a Q&A. So let's jump right into it. Crypto arbitrage is what we do as Future Forex. This is the part of crypto that we specialize in. In fact, it's at present the only part we partake in because of its safety and incredibly strong returns. But let me run through it right from the beginning. So in order to know what crypto arbitrage is, we need to understand the concept of arbitrage. And very basically, arbitrage is the process of simultaneously buying and selling an asset in two different markets. Now, the only reason you'd want to do this is if the price in one market is higher than the price in another, and you can make a profit off that same asset. So let's use avos as an example. So veer away from cryptocurrency altogether. Let's assume that in the US, an avo costs $1, and the exchange rate, wishful thinking, I know, is 10 Rand to the dollar. If avos sold for 11 Rand in South Africa, we could earn a somewhat risk-free profit of 1 Rand per avo by buying abroad, sending to South Africa, and selling in South Africa, right? Now, what Future Forex does is we do exactly that, but we use cryptocurrencies instead of avos. And the reason we're able to do this is because the price of cryptocurrencies in South Africa trade at a slight premium of sort of 2 to 4% versus those abroad. So quite simply, what Future Forex does is it converts clients' money to dollars, buys cryptocurrency with those dollars, sends that cryptocurrency to South Africa, and sells the cryptocurrency in South Africa at a profit. And because of the cyclical nature of this, the fact that clients start with rands, move to dollars, move back to rands through cryptocurrency, because it starts in rands and ends in rands, we can do this multiple times, right? We can use that same money over and over again and keep trading like this, which is how we get to returns of north of 100%. And in terms of our average return, our average annualized return to clients is around 70%. So it is a really, really great, safe way of investing in the crypto space without actually investing in crypto. So instead of investing in crypto, you're taking advantage of or capitalizing on a market inefficiency in the local crypto space. If you've heard enough and want to get involved or want to learn more, there are 3 ways you can contact us. Number 1, you can go onto our website, www.futureforex.co.za. And for those who haven't already, you're welcome to open tabs and check us out while this presentation is going on. You can also email us at info@futureforex.co.za. We'll be sure to get back to you, or you can give us a call on 021-518-0558. So let's talk through the pros and cons of crypto arbitrage. The pros are we've ensured that we do it as safely as possible. We use the most trusted third parties. We ensure we have no cryptocurrency exposure because of the simultaneous buying and selling. So it's extremely safe. On top of this, our process is largely passive. We've done it in such a way where clients have to do as little as possible. We do all the trading, we do everything, and you just watch your money effectively increase. In terms of the returns are extremely high. You can earn up to 250,000 Rand per year. And this almost leads me directly to the first con, which is why can you only earn up to 250,000 Rand a year? Surely if you're earning 70% on average for your clients each year, what happens if I put in R1 million? Am I not going to be able to earn 700,000 Rand? Why is it limited by 250,000? And the answer is because we are limited by our foreign exchange allowances. Each individual can only send up to 11 million Rand offshore per calendar year, which means that should a client give us, let's say, 500,000 Rand, we would only be able to do 22 trades for them because 22 times 500,000 is that 11 million Rand. And then they would be done for the year. The South African Reserve Bank wouldn't allow any further sending of money offshore. So that's the first thing, is that we are limited by how much we can send each year. The second con is that there is a high barrier to entry. So our minimum investment amount is 100,000 Rand. And the reason for this is because of the bank fees, exchange fees being such that if you send less than 100,000 Rand, you may not make great profits because of these fixed fees eating into your margin too heavily. But if you have 100,000 Rand plus earning, not earning particularly well, or in a bank or in a savings account, and you're looking to earn a bit more from it in a safe way, this is a really, really good avenue to look into. I'm now going to hand over to Josh to talk through some other ways of getting involved in crypto, starting with direct investment in crypto.
Awesome. Thanks so much, Harry. So direct investment is the purchasing and holding of a particular cryptocurrency. And this is probably the most popular way that people get involved in the crypto space. they'll buy Bitcoin or Ethereum, hold it for a period of time, and sell it later in the hopes that they'll make profit. And the reason why this is the most popular avenue for people to get involved is because it is the easiest way. All you need to do is you need to register an account with an exchange, and then you send your money there and you can purchase the crypto of your choice. And there's also no real barrier to entry in terms of minimum investment. Most of the exchanges will allow you to purchase cryptos for as little as 100 Rand and upwards. And the crypto exchanges that you can do this on in South Africa are Luno, which is the biggest one, and then VALR, which is a great new up-and-coming exchange. You can also use offshore exchanges like Binance and Kraken. And the thing with these is you'll need to send dollars to these exchanges. But the benefit with using them is that their prices of the crypto are a little bit less than in South Africa. And this is what Harry was alluding to when he was explaining the arbitrage. So the question that always comes up when people want to directly invest in crypto is how do you best go about doing it to make the most money? And there's kind of three questions which cross your mind. First is, which cryptocurrency? Because there are thousands. There's Bitcoin, which is the most popular, and Ethereum, but then there are just thousands of other ones. And when choosing these, you have to think about things like, what is the use case? What is the technology behind it? And also, very importantly, what is the team that has developed this crypto? And that last one is especially important because what's happened in the space, because it's unregulated, is that you get these dodgy teams that create dodgy coins. They sell it, they kind of release it, and everyone buys into it. And very shortly thereafter, they realize that none of the promised functionality is there, and the team has disappeared with all their money. So that's always something to consider when investing in newer or younger cryptocurrencies. And this is why cryptocurrencies like Bitcoin and Ethereum, which have been around for a lot longer, it's one of the reasons why they have much higher values, because their technology and the teams behind them are a lot more trusted. Another thing to look at is the timing. So what often happens is you'll see the Bitcoin price drop, let's say from $40,000 to $30,000, and you'll think to yourself, now's a good time to buy in. But this is something to really be wary of, because it's very difficult to time the market. There's absolutely no telling that 30,000 price point is only the beginning of an even steeper drop down to 20,000. And that's why we always caution our clients against trying to time the market, and rather recommend that they try space their investments over a period of time to basically diversify their risk in terms of timing. And this is all just kind of, this is a result of the volatility of crypto, because it can change from 10% to 20% in a day sometimes. And it's also why it makes it not the greatest short-term investment. And the last thing I want to touch on here is macroeconomics, which is arguably the most important thing to look at. And people often do not look at this. So what I'm talking about here is that the global economy and the crypto market are not independent. But when people look at investing in the crypto market, they often look at it completely independently, as if it's immune to what happens in the outside world. And that's quite a big mistake, because they are very, very correlated. For example, recently, the price of Bitcoin has dropped substantially into the $30,000 range from upwards of $50,000. And this has largely been due to rising inflation rates and the expectation of also rising interest rates. Similarly, last year, when the price of Bitcoin shot up above $60,000, this was due to basically the reverse happening. The American government was printing trillions of dollars, and all this money printing caused prices of assets like stocks and cryptos to rise. And that's why we always recommend, when you are looking at investing in this space, look at what the global economy is doing, because that will help guide you as to what the crypto market will do at large. So as we've kind of been through, the the pros of directly investing in cryptos are that there are great potential returns. You can see the graph on the right, that's the price chart of Dogecoin last year. And as you can see, if you invested at the right time and sold at the right time, you could have made a very, very handsome return. Another added benefit is that on some cryptos, you can earn staking rewards. So what this effectively is that if you hold the crypto, you can basically earn an interest rate on it. And then crypto has a really low barrier to entry in that you just have to register an account in a crypto exchange and you can start buying. And another added benefit is that you can invest just about any amount from 100 grand upwards and get involved. On the con side, just like there's big potential upside, there's also big potential downside. And that graph on the right is quite simply the continuation of the graph I showed on the previous page. So shortly after Dogecoin reached its peak, it went on a very long decreasing trend. So quite similarly, if you'd gotten in at the wrong time here, you could have lost a lot of money. There's also very high volatility, and this makes crypto generally a pretty poor short-term investment, because if you invest in it and then you need to take your money out a month later because you need it for something important, there's a good chance that you'll have less money at that point in time. So it's better in general as a long-term investment if you really believe in the technology, the team, or the macroeconomics. And another thing to be cautious of is scam coins, and this is also regarding if there's a dodgy team behind the coin, they can effectively make a coin that doesn't live up to what was promised and then just run away with all their investors' funds. And lastly, something I forgot to mention a bit earlier is the exchange fees. So as a general rule of thumb, the easier it is to purchase cryptocurrency on one of these exchanges, the more fees they will charge. And these fees can range from 2 to 5%. And what that means is that if you buy and then sell, you can have lost already 10% of your funds just from the trading. So these can really eat away at your profits, and it's something to look into whenever purchasing crypto. And Future Forex does offer an over-the-counter exchange if you are wanting to purchase cryptocurrencies and not have to pay exorbitant fees. So I'm going to move on to mining next. And before I get into mining, I think it's important to understand a little bit about how cryptocurrencies and the technology behind them, blockchain, works. So basically, what blockchain is it's this decentralized network of people around the world, and they're completely random people, right? Nobody really knows who each other is. And these people have to work together to maintain the blockchain network. And how do you do this if you don't know the people? Because normally a company has a trusted authority and it's in there, the company will maintain its own network and it's in its own interest to do so. But now you've got people around the world, how do you ensure that they are trustworthy? And the way blockchain does this is it gets these people to do a certain amount of work to prove that their best interests are aligned with that of the blockchain. And that is effectively where mining comes in that these people have to also be incentivized to do this work. So people are incentivized to do work to maintain the blockchain, and in so doing, they get rewarded for it. And the way that people do this mining is they use specialized hardware. It used to just be, you could do it with a computer, but these days you have to use GPUs and ASICs, which are very costly. Something like the AntMiner S19 Pro can set you back $11,000, which is quite a pretty penny. And then what this hardware does is it uses a lot of electricity and it completes very complicated equations. And basically this high electricity usage is actually becoming a bit of a global problem. Bitcoin mining alone used more than all of the electricity consumption of Finland last year. And Finland's got a population of 5.5 million people. So it's very substantial. Once you've got the hardware, you then need to install a mining script. This is basically a piece of software that will send instructions to the hardware and utilize the hardware to conduct the mining. And the software is open source, so you can get it freely, but it's not the most user-friendly, and setting it up can be quite technically challenging. So the pros of mining are that once it's set up, it's basically passive income. The hardware will just do its job and the software will keep running it. You can tweak things to make, to optimize your earnings, but by and large, you can just leave it be to do its work. Another pro is that you can resell a lot of the hardware. So the GPUs in particular, those are graphics processing units, are used in computers for computer gaming and video editing. So they do have other value outside of the crypto space. On the other hand, and this is why I put a star there, things like ASICs, which are purpose-built for mining Bitcoin, will lose most of their value if the Bitcoin price drops and the mining becomes less lucrative. And then a last pro here is that you're not always limited to a single cryptocurrency. For example, with GPUs, you can mine lots of different cryptocurrencies, which is great because if the one you are mining drops in price and your profits decrease, you can always just switch to another one which is more profitable. But this actually leads me to also one of the cons of mining. And that's just that your returns are heavily dependent on the crypto being mined, especially if you hold the crypto when you and you don't sell it for an extended period of time. And just to be clear, the rewards with mining are paid out in crypto. They're not paid out in rands or dollars. So if that crypto's value decreases, so do your profits. And while you can swap to a more profitable crypto, what's important to realize is that the crypto market usually moves in tandem. So often when one coin drops, a lot of other coins will drop. So it won't always matter which you switch to if they're all dropped in price. Then, as mentioned, it is environmentally harmful. I'll give you guys one more interesting statistic. The CO2 emissions of Bitcoin last year were the equivalent of 15.5 million cars. And that's only Bitcoin mining. There's still Ethereum mining, which is a whole another story. And then it's also technically challenging to set up. You've got to choose the right hardware, build these mining rigs, and then also set up the software. So I don't recommend it for someone who doesn't have some technical experience. And lastly, there is quite a high barrier to entry in that to get an entry-level mining rig going, you're going to need at least 20 to 30,000 Rand. And that about sums up mining. I'm going to hand back to Harry now to talk you through DeFi.
Yeah, thanks, Josh. So DeFi stands for decentralized finance, and this is quite a buzzword in the crypto space because what it effectively does is it's trying to reshape finance as we know it. So let's first look at traditional finance. Let's look at what we know as finance. If I have money that I want to earn interest on because it's not doing anything, I can give it to FNB and they might give me 4% per year if I'm lucky. They will then take that exact money of mine and lend it to, let's say, Josh, who wants to borrow money, but he'll have to pay 10% to borrow the money. So FNB will pocket the 6% difference. They'll give me my 4%, they'll take in the 10%. Pretty simple concept that happens with all banks. Now, what DeFi says is it says, let's challenge this concept. Why can't we make a decentralized platform, one whereby no one actually takes a profit or operates it, and instead of that, we can have a peer-to-peer lending system. So now what might happen is I might, again, want to lend my money so that I can earn interest, and Josh might want to borrow money. But what will happen now is I'll give it to the decentralized exchange anonymously. Josh will then take it anonymously. I won't know who I've lent to. He won't know who he's borrowed from, but I get more money. He pays a lower rate, and it basically cuts out the middleman of the central institution. And that is what decentralized finance is in a nutshell. decentralized finance takes many forms. There are decentralized exchanges where you can swap cryptocurrencies. For example, if I've got Bitcoin and I want Ethereum, but Josh has Ethereum and he wants Bitcoin, I can go onto this decentralized exchange and offer my Bitcoin for Ethereum. Josh will offer his Ethereum for Bitcoin and we will swap, not knowing who each other are. An example of this is Uniswap. There's also something called decentralized lending, whereby I can lend my money to someone else can borrow my money via one of these platforms. And this is examples of this are Curve and Aave. And something that's probably closest to me, being an actuary by trade and having spent years understanding the insurance industry, is something called decentralized insurance, whereby there's actually no Old Mutual, no Sanlam, no MyWay, no central figure, which is an insurance company. Rather, what happens is some people provide money for insurance cover, others pay premiums to have that insurance cover, and those premiums go straight to the people who would provide the cover. So you can be on either side. It's basically a peer-to-peer insurance provider, where you can be on either side. You can either provide the liquidity and collect the premiums, or you can pay the premiums and be covered from something like a crypto hack. An example of this is Nexus Mutual. Next, I want to go on to something called liquidity mining and yield farming. And these are very lucrative ways of making a lot of money in the decentralized finance space. So let's start with liquidity mining. Very simply, liquidity mining is providing your, let's say, Bitcoin to an exchange. And by the end of the year, you maybe earn 10% on that Bitcoin. So you maybe provided 1 Bitcoin. At the end of the year, you'll have 1.1 Bitcoin because you effectively charge people fees to use your Bitcoin for their duties. So the exchange charges fees, they give a high percentage to you, and you get interest as a result. So you earn money on your asset by providing it as liquidity. Yield farming is similar and can be used to complement liquidity mining, in that yield farming, instead of being paid the base token that you started with. So for example, if I give 1 Bitcoin and with liquidity mining, I might get 1.1 Bitcoin. Instead of that, I'm going to keep my 1 Bitcoin, but get something called a native token. Now, each site or each platform has their own native token. And effectively, you can, depending on which site you're on or which platform you're on, you can collect this native token as well as earning interest on your Bitcoin. So by the end of the year, they tend to work in tandem, liquidity mining and yield farming. So by the end of the year, you might have 1.1 Bitcoin and 5 native tokens from this site or this platform. And what you can do with these native tokens is you can invest them in liquidity pools and basically keep farming rewards, as it's called. So yield farming these rewards. So let's say you've heard enough from me and now you think this has some real merit here. I want to get involved in decentralized finance and yield farming or liquidity mining. How do you get involved? And this is where it gets complicated. So in order to get involved, you have to create something called a virtual wallet on a platform like Metamask. You then have to send your crypto to that Metamask account and choose the liquidity pool you want to participate in and send your Bitcoin to, or your crypto to that liquidity pool. There are loads of mistakes that can happen along the way. There's no recourse if something goes wrong. So effectively, this is extremely difficult for individuals. And this is where I would exercise great caution. If you do want to do something like this, I really recommend either extensively researching it or talking to an expert about it. So what companies have done is they've created something called vaults to make this a bit easier. So something like Luno, if you put your Bitcoin in Luno, you can earn, I think it's up to 4% on your Bitcoin. And what they're effectively doing is they're saying, great, we'll hold your Bitcoin. We will do a whole bunch of stuff with it, including liquidity mining, yield farming. We'll do all of that, and we'll give you a little interest on that. And this is called a vault. Now, 4% is really low relative to what they're earning on those funds. So for that reason, I've said, watch this space, because we are looking to branch into the space to make it easy to get involved in these areas without the associated risks and getting far better returns than currently available in South Africa. So let's move on to what are the pros and cons of DeFi in general. So of course, if you know what you're doing, that's the huge contingency here, is that if you know what you're doing, you can make great potential returns and the risk can be low if you know what you're doing. On top of that, as I mentioned before, there's some serious advantages to it being a decentralized, to this all being decentralized. You open up to the entire world, you can trade with anyone in the world. There's no risk of the third party in the middle going bust. There's no extra profit that they're taking to the extent that they do in traditional finance. So those are some of the pros. The cons are that it's extremely risky for people who aren't experts in the field or people who don't know much about the field. On top of this, the crypto industry is notorious for scams and something called rug pulls. Now, rug pulls are pretty similar to what Josh was talking about earlier, whereby someone creates a coin and it has no value, and then they just run away with the millions of dollars and you lose all your money. The same can be said for any liquidity pool, any platform. So you need to be really careful of these and do your research pretty efficiently. Some further cons, as I've mentioned a few times, is that it's extremely complicated to get involved. And even if you do want to get involved, it's difficult to access as a South African. So this is where Future Forex is going to hopefully come in the near future, making sure we can remove that barrier to entry. So that's a run through of the DeFi space. And I know it's a very complicated concept, but this is just to give you a high level overview of what's happening in decentralized finance. I'm going to now hand back over to Josh to talk you through NFTs.
Thanks, Harry. All right, so let's enter the wacky world of NFTs. So what NFT stands for is non-fungible tokens. So what fungible means is something that's replaceable by another identical item. So if something is non-fungible, it means it's not replaceable or interchangeable. And that basically each one is unique. So for example, Bitcoin is a fungible token, which means that if you've got Bitcoin, if you've got one Bitcoin and I've got one Bitcoin, we can swap them around and there will literally be no difference. But with an NFT, if we did the same thing and we swapped our NFTs, we would then be holding completely different NFTs. And because of this unique nature, NFTs are a useful tool to represent ownership of digital and even physical items. And they've kind of become prolific, especially with digital artwork and digital music, because these pieces of media can be attached to the NFT directly. But the thing is, once you buy an NFT and you open it up and you get the picture, you can copy that picture 1,000,000 times over, send it to whoever you want. And yeah, you can send it to as many people as you like. And this is why a lot of people ask, well, why do NFTs have any value if you can just kind of duplicate them 1,000,000 times? And this is actually, yeah, it touches on an interesting point of human psychology, and it's just the sentimental nature of humans. And you can draw quite a few parallels between NFTs and real art. For example, if Picasso makes a painting, and then you go and copy it, and you make a perfect copy, but people know that it wasn't painted by Picasso, they're not going to be willing to pay as much as for the original. And that's basically why NFTs, which give you ownership to the original artwork, even if it's a digital piece of art, have got such a high value. And some interesting examples of this are Ether rocks, which you can see a picture of those very pretty rocks on the right. Basically, this project, they created 100 of these rocks, each with a very different color, super exciting, as you can see. And if you bought the NFT, if you bought one of the rocks, you basically were the original owner of that picture of a rock. And believe it or not, one of these rocks sold for as much as $1.3 million. So very, very interesting space. You also then have things like CryptoKitties, which is a cool idea. It's basically NFTs blended into a game where you can purchase these unique CryptoKitties. You can then go and breed them to make more CryptoKitties, and then you can even sell the CryptoKitties you breed. And if you know what you're doing, you can make you can make a few extra bucks. And then there's also CryptoPunks, which is very similar to the other two. So if you want to get involved with NFTs, the way you can first do it in terms of buying an NFT is you need to get yourself some Ethereum, because all, well, not all, but 90% of NFTs are on the Ethereum blockchain. You can then send that Ethereum to a Metamask wallet. And once you've got the Ethereum on a Metamask wallet, you go to a platform like Opensea, which is the biggest NFT marketplace, or Rarible or Mintable, and you can choose your the NFT that you like, and you can pay for it using your Ethereum. Then if you wanted to sell an NFT, it's actually quite easy. You can go into those same platforms and you can create an NFT very, very easily. You can just attach your media to the token and you can put it on the market for whatever price you like. The thing to keep in mind is that thousands of people are doing this every day, and therefore most of these never sell, and if they do, they sell for very, very little. And the only real way to get NFT to have value is to build up that sentimental nature. And people typically do this by, driving hype, by going on Twitter or social media and getting people really keen to own the original version of that piece of media. So the pros of NFTs is that if you know what you're doing, you can make potentially great returns. You got to follow market trends, help build up hype, see where the interest is, and you can purchase the right NFTs, which will increase in value. It's also a great platform for artists, especially artists that are looking for a global market to sell their artwork to. And there are a lot of artists around the world that have been making a fantastic living by creating their art and selling it on the blockchain through NFTs. And then it can also just be fun for people that are hobbyists, collectors, with games like CryptoKitties. They're really well done. And if you do it right, you can even make some extra money from it, which is always also fun. The cons, though, are that these values of NFTs are highly speculative because it's all based on sentimental nature. If that disappears, the value of your NFT will disappear. So you can end up buying an NFT for say 1,000 Rand, and then a week later find that you can't even sell it for 10 Rand. There's also security concerns when storing NFTs because if your wallet does get, if the wallet where you're storing the NFT gets hacked and someone gets in there and they steal your NFT, there's no getting that NFT back. It's gone for good. And lastly, that you've got to be wary of the high transaction fees, because most NFTs on the Ethereum blockchain, which has very expensive fees. These fees range from hundreds of rands, even into the thousands sometimes. You've got to be careful that those fees don't rack up and really hurt your profits. So that is NFTs. I'm now going to hand back to Harry to conclude.
Thanks, Josh. So as you can see, there's a lot happening in the crypto space. It's a bit of a wild west at the moment. Guys are trying all sorts of things. And we're just trying to break this down into what are some of the major themes in the space and how can you protect against them, and where should you look to get involved if you do want to get involved. So let's conclude looking at the potential returns and risks of each of the investments we've spoken about. So let's start with crypto arbitrage. As I said, this is what we have the deepest understanding of and what we believe to be by far the safest way to get involved in the crypto space, in that you're not actually investing in the crypto assets, but rather capitalizing on a market inefficiency in the crypto space. So in terms of crypto arbitrage, the potential returns are high and the risk is very low. Direct investments in crypto, their potential returns are extremely high. We've seen people make 5, 10 times, 100 times on their Bitcoin. These guys who got in really early. At the same time, the risk is very high. We've heard of coins that go to zero. We've heard of coins that lose 90% of their value in a day. So you have to only invest. My motto is only invest directly in crypto what you're willing to lose. So if you're going to go direct investment route, if you want to take punt on one of these coins, go for it, but just be aware that you could lose that money. Josh spoke to us about mining, which has high potential returns and high risk. The reason it has high potential returns is because you can start being rewarded with loads of Bitcoin, loads of Ethereum, and if it goes up in price, you do extremely well. But because it's linked to the crypto price, the risk is also high in that should the price of Bitcoin halve in a short space of time, as it has done recently, you've put all this money into your mining equipment, and it's not worth that much because the rewards you're getting aren't particularly high. Decentralized finance, again, if you know what you're doing about if you know what you're doing in the space, the returns are high and the risk is moderate. However, if you don't know what you're doing, the risk can be astronomically high because there's so many guys are setting out trying to take advantage of people. So unless you know what you're doing, but if you do know what you're doing, it's high returns and moderate risk. And finally, Josh told us about NFTs, which, as he mentioned, that very pretty rock went for $1.3 million. So the returns, to say they're very high is an understatement. They can be astronomical. However, the risk is that imagine you're the person who bought that rock for $1.3 million and you try to sell it and someone says, I won't even pay you $1 for that. That's a picture of a rock. So the risk of investing in NFTs is also astronomically high. So that concludes our presentation. As I said, if I were to get involved in the crypto space and dip my toes in the water of crypto, I would start with crypto arbitrage in that, as I said, you're not directly investing in the crypto assets and you therefore aren't exposed to the volatility of the crypto space. But on the flip side, you can make extremely high returns. Thanks so much for listening to us. And I believe we're now going to open up to a Q&A to see if anyone has any specific questions.
I have a question, if I can just unmute and ask. Cool, thanks so much. I just want to know, what are the tax implications of doing the crypto arbitrage with you guys, or in general, if there are any?
Yeah, it's a great question. And hello, Shavit, how are you? Yeah, it's a great question. And the tax implications are that it's taxed as income. So it will be based on your marginal tax bracket. So depending on what you earn, you just add it to what you earn each year. So let's say you make 200,000 Rand from crypto arbitrage in a year, you're going to report to SARS whatever you earned that year from your job, from whatever else, and add 200,000 when doing your tax return.
Awesome, thank you.
Can I ask, can one invest?
Yes, Stephen, go ahead.
Hello, if I can one invest actually in the blockchain technology itself, or is that not really an option?
I'm happy to field this one. So Stefan, you can basically invest in the blockchain technology by investing in a cryptocurrency, because that is what a lot of the sentiment or the speculative value is of the cryptocurrency, is the technology behind it. So that is how people do it. There's no other way to like directly invest in blockchain technology. There, to my knowledge, there aren't any public companies that are high, or that a large portion of their value is based on the blockchain technology that they're developing. The closest is probably Facebook or Meta, that if you're wanting something that's outside the decentralized space, but generally people will just invest directly in a particular crypto.
Can I ask a question about the arbitrage long term? So, I mean, obviously, the more aggressively you go after arbitrages, they tend to shrink over time. And what is your plans around that for the people that invest? Is there always going to be an arbitrage in your opinion, or are you looking at other ways to arbitrage?
I'm happy to field this one, Mark. Firstly, Mark, I remember you from when I was a kid. I used to play chess, and I know you made something called Chess Cube, which I used to play on quite regularly. So good to see you again.
Absolutely.
Yeah, so it's a great question. What arbitrages by nature shrink, and in particular, any arbitrage you find on a market is probably closed out within 30 seconds usually. So the question becomes, why has this one been around for 5+ years and not shrunk to zero? Surely this must shrink. And this goes back to the exchange allowances that I spoke about, because each individual can only exercise up to 11 million rands worth per year through the arbitrage, which sounds like a lot, but relative to the volumes of crypto being traded in South Africa, it's a drop in the ocean, meaning that we're nowhere near seeing that gap close. However, you're right that over time, as more people sort of pick up the light bulb clicks that this thing is a somewhat risk-free way of making extremely strong returns, eventually they'll get to a point where it will narrow and narrow and narrow to an unfeasible level. So what we've done is we're embarking on other products in the crypto space, which are also safe, also extremely well covered and well insured in such a way that we can make very strong returns. One we're looking at quite closely is the ability to make real returns in dollars through something called stable coins, which are one-to-one coins, one-to-one with the dollar. So they're one-to-one pegged. In other words, you can make up to sort of 10, 20, if you're being risky, 30% in dollars by investing in a one-to-one backed coin. So these are the sort of things we want to give to the South African market and make easy for the South African market. So we're looking to pivot in that case, but right now the arbitrage is alive and well and kicking, and we feel make hay while the sun shines.
Great, thank you.
Harry or Josh, I've got a question. Do cryptocurrencies have actual value?
I'll let Josh field this one. He feels more strongly about this than I do, so I'll let him run through this.
Yeah, so that is, I guess, the debate that's on everyone's mind. And the reason or the argument for cryptocurrencies having value is that they give people a means to transact outside the sort of regular framework for transacting. And the benefits of that, one of the big benefits is, for example, global transactions can be conducted a lot more simply. You know, for example, in South Africa, if you want to send money offshore, especially a substantial amount, it's quite a process because there's exchange controls and you have to fill out balance of payments forms, and the banks also charge you quite hefty fees. And blockchain allows you to get around this and pay much lower fees. And also you can do the global transactions very quickly, you know, whereas an international payment can sometimes take days to reflect overseas. You can use cryptocurrencies and do it within minutes or even seconds. So because of this and the various other functionalities of blockchain, such as smart contracts, there is definitely its use cases for cryptocurrencies. And now the question really is the value correct? And that's also very much up for debate. If I knew the answer absolutely accurately, then I could probably be a billionaire within a few years' time. But the truth is that a lot of it is just speculation, and a lot of it is people buying in because they think people will buy in after them. And if you believe the value is going to go up and you buy in for that reason, it can inflate the value. And to how much of a degree that's happened, we can't be certain. But yeah, just to kind of circle back to your question, Lisa, there is inherent value in my opinion, but whether the current price tag is correct is a whole nother story.
Thanks, Josh. Any other questions from the group? We've got a couple more minutes. Harry, sorry, I know you touched on, oh, sorry, go ahead, I beg your pardon.
So if there isn't, it's a question relating to the inherent value. So if the inherent value, you can't actually verify it, how can that be risk-free? I can't get my head around it, I'm sorry.
I'll field this. So crypto certainly isn't risk-free as an industry. It's highly risky in that you can invest in a coin and it can halve in price, it can double in price. and that's why crypto certainly isn't risk-free. What I was saying is extremely low risk is the arbitrage trading, because in the arbitrage, you buy on one exchange and sell on another at exactly the same time, meaning that you actually never hold any exposure to the asset. So let's say that crypto halves in price while you're trading. It doesn't matter because you've bought it on one and sold it on the other. So you have a net zero position. So you're not going to lose any money. Same is unfortunately true if it doubles in price. You're not going to make any money off that because you're in a net zero position. So crypto arbitrage, extremely low risk. Crypto in general, pretty high risk.
Okay, thank you.
Am I on mute? Just let me check. Harry, sorry, I know you did touch on this in the beginning, but if you could just maybe recap around the regulations. I understand that cryptocurrency is not regulated in South Africa and it's completely legal. But won't you just unpack that a little bit so that everyone is clear on the status in South Africa and just give us context to this so we have a clear understanding. Thank you.
Yeah, absolutely. I, for one, cannot wait for the government to regulate cryptocurrency because it will give legitimacy to those institutions that continue to perform cryptocurrency services, because it means you have to have been audited, you have to have said that you're doing what you say you're doing. Unfortunately, as Lisa alluded to, at the moment, there is no regulation. It's unregulated, meaning anyone can pick up sort of a pen and try to tell someone that they must invest in this one crypto, and they don't need any experience, they don't need any exams, nothing like that, which creates all these scams and all these people running away with millions of rands, millions of dollars. So if you put your hands in the wrong company, you can be in serious trouble. Now, Josh and I have a compliance team, or Future Forex, I should say, has a compliance team that are working day in, day out, talking to the SARB, talking to the regulators, saying, what more do we need to do? Please, let's get regulation in place, because we're ready for it. We've given all statements, everything we need to the regulator, and are waiting for them to say, right, let's regulate it now, because that will inherently provide more trust to players like us who are fully regulated and are doing things by the law, and weed out those that are trying their luck, trying their hand without the relevant expertise or knowledge. So because of that, the government have said, and they've said a lot of things in the past, they've said that during the first half of 2022, the draft regulations will be in place and we'll all have to adhere to them. So we're really looking forward to that and hope that it comes to fruition. However, we've seen enough times with this government that when something's said, there's often a delay. So I wouldn't hold my breath on it being by the first half of this year, but that's what they've said will happen. Does that answer your question, Lisa?
Yes, thank you. Thank you.
Okay.
Just one last question's come through from Judith around the environmental cost. You'll see it in the chat room. What is the problem with the environmental cost? What happens if new regulations limit the damage to the environment?
Yeah, I'll take this one. So I think one of the problems with the environmental cost is, well, obviously there's global warming, but I think a sort of slightly deeper issue is the fact that the environmental cost of blockchains is because of old technology. There's been a lot of new blockchain technology or consensus algorithms which have been developed to overcome this environmental cost. And a lot of the problem comes from the fact that the old technologies are still predominant, which is why the environmental cost is still so high. And it seems a bit silly when there's these newer technologies which we don't have to have this huge environmental cost. And just in terms of regulations that limit the damage to the environment, that's unlikely to come in, Judith, just because a lot of the actual mining of crypto, which is where the environmental cost comes in, takes place in other countries. It used to take place mostly in China, but now it's in America. And if they did limit it in South Africa, they wouldn't be able to impact what's happening in America or wherever the minings take place. And these miners can move around pretty easily. So if their country does regulate to prevent the environment, they could always just move to a country that has more lax regulations around it.
Okay, well, thank you both, Josh and Harry, for really an amazing and educational session. I feel hugely informed, a lot of words and a few things I'm confused about, but really you just gave it all to us. So thank you so much, and we really appreciate it. I hope our audience enjoyed what Josh and Harry had to share, and that you all learned something from this morning. If you would like to know more, just connect with Josh and Harry directly, and I will send the link, the recording link, to you later today. So thanks for joining us, and all the best. Keep well.
Thanks very much, guys. Cheers.